This is your Mortgage Rate Watch for Wednesday, December the 15th, and I'm Keith Akada with the Mortgage Drill. So what happened yesterday? Well, with the Federal Reserve announcement, they had strategic words, and they had mentioned that they're not going to be paring back any of the $600 billion worth of the Quantitative Easing 2 buying program. In fact, they will inject a full dose of the stimulus package into the economy. So Wall Street liked this. And why Wall Street liked this? Because keep in mind, the Fed's main plan is to stimulate Wall Street and stimulate stocks. Well, definitely that happened because Dow Jones reached an all-time high that we haven't seen in over 2 years. Now, for the bonds, unfortunately, that money has to come from somewhere, and it's coming from the expense of the bonds. And what we're seeing right now is investors are not only not adding to their bond positions, but now they're selling them off, current holdings, to go into invest into stock market. So that's coming at the expense of bonds. Another thing that happened is they really did not address any of the sudden spike in home loan rates. They are trying to say that this is going to help by pumping money into Wall Street, into the economy, that it's going to help stimulate jobs and it's help stimulate corporate America, and therefore, in the bottom end, help stimulate the housing recovery. We're a little bit torn from that just because of the fact that if interest rates spike too high, and now we are definitely 1% higher than just 3 weeks ago. So we are now touching 5%. So, with these numbers, could it really stimulate housing? Well, it's yet to be seen if these interest rates are going to bear. Now, one thing that we do want to put out there is that if we're going to do something that's a 2-year market kind of recap, and what we want to put out there is year over year, November, anytime after Thanksgiving, the bond market definitely does worsen. And that's just because stock market gets into a full-fledged swing, and it's their last hurrah to close in the year-end books. And then we go into the first quarter of the next year, and it's all about the corporate earnings. And depending on how corporate earnings come out, we start to see a downtick in Wall Street, a little bit of a sell-off. Now, the other thing, too, is bonds normally get very oversold toward the end of a year. And beginning in the new year, we do see some of those bottom feeders come back into the market and start investing into bonds again. That is something as a historical pattern that here at the Mortgage World we're looking to hopefully see happen, but it's a little bit too early to blow that whistle. So for right now, it is a locking stance, making sure you're working with a lender that has that float down option. But the key thing here is you've got to create a ceiling because there's still so much more volatility. Even after the president spoke today about the federal tax cuts, unfortunately, the bond market worsened, and the stock market normally, which is unfortunate, Dow Jones normally doesn't like it when the president speaks, sells off. They actually moved back up. So this is all coming, unfortunately, for homeowners at the expense of mortgage rates. For those long-term bonds, 30-year mortgages, the 30-year bonds are tied to that. The 15-year mortgages, 15-year bonds tied to that, unfortunately, are not looking attractive at this point to investors. So the sell-off probably will continue, and with the sell-off brings higher interest rates. So right now, we're definitely putting a red flag out that you have to lock your interest rate the minute you get into a purchase and sales agreement for buyers out there. And for any people that are considering refinance, if you have not done it, boy, we're not going to say you missed the boat completely. We will have some pullbacks here in the future, but the chances of us falling back down below that 4% level seem to be very, very grim at this point. Any breaking news, make sure to follow us on our Twitter and Facebook fan page. We'll talk to you real soon.